Hi, and welcome to another episode of Life and Equity, where I talk about life and life experience, and of course, equity or finances. Today, I want to talk about velocity banking, what it's typically referred to, and personal or family banking with life insurance. I want to talk about some differences and some attributes of both. They're very different things. So, first of all, we'll start with velocity banking. Now, velocity banking, at least in the way it's commonly presented, is the idea of using a HELOC to accelerate the pay down of other debts. And I'll get into a diagram of that. In fact, I'll pull that up on screen. Both of these things, I've had experience with both of these things. So velocity banking, again, is the idea that you take out a HELOC or a home equity line of credit on your home. And then you use that HELOC, you use the dollars from the HELOC to pay off, let's say, high interest credit cards. And what you're doing is you're basically taking a loan from your HELOC. So you actually let me put it this way. So you take a loan from your HELOC to pay off the credit card, and then what you do is you take your income and you deposit that directly into the HELOC. And you do that, if you're paid monthly, you do it at the whenever you're paid. If you do it bi-weekly, it would go in there a couple of times a month, and sometimes three times a month. And if you're paid twice a month, then it would go in twice a month. And then if you got multiple income sources, maybe two working spouses or additional income streams, all of that money would go back into the HELOC and reduce that balance. And then throughout the month, so let's just hypothetically say you get a check, your checks come in on the 5th, as an example, and the 20th. So your deposits go in on the 5th and the 20th. That's your income. And then throughout the month, as expenses come up, you would then take from the HELOC to pay those expenses. And so you might have a house payment come out on the 25th. You might have food that you purchase on the 10th and the 30th, or whatever the case may be. Maybe you do it once a week, however that looks. Utilities generally come out once a month, let's say on the 15th, and then gas that comes out, let's say four times a week on that. So once per week. Once per week. We'll put that for the food as well. And basically all your expenses you pay for one per week. So again, income goes directly into the HELOC to pay down that balance, and then throughout the month you pull money out of that to pay for lifestyle or living expenses. And then the next month you have another um, uh, more checks come in, and that again pays down the HELOC, and then the balance goes up a little bit as you pay your living expenses. More checks come in, it pays it down. So there's a continual fluctuation, and the idea there is you're saving interest. And there's a lot of nonsense. There's a lot of noise out there that you're not paying as much interest because you're paying the interest on like specific cycles, so it's less interest. None of that's true. The simplicity, like, there's no magic to it. The math is, and the reality of it is, you're paying down the debt, and so you're being charged less interest because your debt's lower, and then as that builds up throughout the month, again, you're being charged accordingly, and then you pay it down, and it builds back up and you pay it down. So basically you're being charged interest for the money that's being used. There's no magic to it. It's simple math. So, and the only way this works is by having more income going in than expenses coming out. That's the only way it works. If it's going the other way, then you're going to keep building up a balance on your HELOC, and your lifestyle is still more expensive than that. So you're basically the balance on your HELOC is never going to get paid down. It's just going to, I mean, it's going to fluctuate, but it's going to go up. It's going to stair step up versus stair stepping down. So again, the only way this system works and this concept works is if you have more money going in to the HELOC than is coming out. Talked about this on another video where I said, uh, one of the things you want to get to as soon as possible is live below your means, meaning spend less than you earn. Plain and simple. Same concept works here. Again, it's not magic, it's math. Now, the idea is once you eventually, if you take a loan here, let's say this loan is $10,000, you pay off that credit card, your HELOC balance fluctuates and it's ideally going down until it hits zero again. And then the idea is take another loan, pay off take another loan from your HELOC, pay off another outstanding debt. And I just put a couple of different categories: auto, education. They've even got mortgage in here. And again, the idea is, let's say you owe 8,500 here, and you owe, let's say 25,000 here. And essentially you can just chunk down that debt. So even like as an example on this education debt, maybe you don't take the whole $25,000 out at once. Maybe you chunk it down and you say, hey, I'm gonna take $5,000 at a whack. So you borrow 5,000 from the HELOC, go and pay 5,000 on the education loan. And then you stair step that debt down on the HELOC and you borrow another five and pay that down and pay it and continue to do that process. And the same thing is recommended or talked about to do on your mortgage. So I want you to consider something here. The concept is sound. However, again, because there's no magic to it, like take the magic out because it's not magic, it's math. It's all math based, it's principle based. So this worked really well if your mortgage was, let's say, 6% and your HELOC was 3%. Then it may have made a lot of sense to do that. And I'm not going to get in, like there's a whole lot of other information that would come into play outside of just 6% here, 3% here. You got control, you got risk, you've got all like a whole bunch of different factors that would play into a specific decision. But again, going back to the math, if you have a 6% mortgage and you have access to 3% HELOC money, it may make sense to do this, and then you would chunk down your mortgage and you could actually reduce your mortgage very quickly that way. Again, not magic, it's math. It's all coming down to how much money is going in versus how much money is coming out. It's going to determine how fast you pay that down. So it could be argued that, hey, why don't I just go and make the extra payment down to the credit card, to the auto, to the education, to the mortgage? That's a sound, solid principle as well. This again gives you the ability to throw your, if you borrow, let's say $5,000, and then your income is, let's say, $4,000 a month, and your expenses are 3,000. It allows you to borrow $5,000 on your HELOC, and then your checks come in. That's $4,000. So you take from a $5,000 HELOC balance down to 1,000. And then throughout the month, if your expenses are 3,000, then it's going to go down to 1,000, up to 4,000. And then the next month you pay it off completely, and then it goes up to 3,000. And then you pay it off again, goes up to 2,000, so on and so forth until you've eliminated it, and then you borrow again. But in that case, again, we're having more money come in than is outflowing. Now, what doesn't make sense is if you have a 6% mortgage here and your HELOC, like today's rates, they're right in the ballpark of 7.5 to 8%. So what does not make sense is to borrow at 8% to pay off 6% interest. That doesn't make sense. And again, if you take the magic out of it, and there is no magic in this, it's pure principle based, it's pure math based. There's no magic. And if you take the magic out of the elusiveness or the woo-woo factor and just say, hey, what is it truly? Well, you're ideally borrowing at a lower interest rate to pay off high interest debt, aka credit card debt, possibly auto debt, possibly. Auto rates are not very high. Education debt, generally not very high. However, if it is, let's say your education debt is 12%, sometimes some private money loans are easily 12%. Or your auto debt, let's say that's 12%, and your credit card is, well, let's just be modest about this. Let's say 25%. So if it looks something like this, so your credit cards are 25, your auto is 12, your education is 12, and your mortgage is 6, and your HELOC is 8% money, well, it might make sense to do this to knock out the credit card, to knock out the auto, to knock out the education, but in no circumstance would it make sense to do this with the mortgage. Now, if you still wanted to get out of debt, and a lot of people do, we use this exact system to eliminate all of our debt, including our mortgage. But again, the rates were flipped, where the mortgage rate was higher, the HELOC rate was much lower. So we were able to do that very quickly. However, and I'll talk in another conversation about, whether that made sense or not. But this is a sound concept and it works very, very well. But it all comes down to more going in than is coming out, plain and simple. So you got to be disciplined. I would never, never recommend this to somebody who is not disciplined, because what happens is they say, hey, we just eliminated our credit card and auto debt. We put that on the house. Hey, but you know what? I only have to make the minimum payment there. Look at that new truck and look at this new toy and look at this vacation that I want to take. Well, guess what? If they're not disciplined, what happens is they transfer short-term debt, aka credit card, auto, education debt, onto a long-term HELOC, and then they go rack up their credit cards again. Completely insane. So if you're not disciplined, stay away from this. If you are disciplined, it can make sense, but it's only if the math works out. So in this case, if this were the case, yeah, you could knock out your credit card, your auto, and your education debt. However, it does not make sense to borrow at 8% to pay off 6% debt. So in that case, you would just say, hey, if my income is $4,000 a month and my expenses are $3,000 a month, and I'm intent on paying this loan off, this mortgage off, then start putting the other $1,000 on your mortgage. Don't use your HELOC for that because it doesn't make sense. Doesn't make sense to borrow high interest to pay off low interest. So this is the concept of velocity banking. Like I said, the principle is sound, the concept is sound, but there's no magic to it. It's just simple math. So if you hear woo-woo and magic stuff, just walk the other way or find somebody else who can show you how to do it. Because yeah, don't make it something it's not. Now let's talk about personal or family banking using whole life insurance. This is a concept of funding a life insurance policy that is specifically built to increase cash value or to accumulate cash value, and then you can use that cash value for whatever you want as a personal banking system. Now, make no mistake, it is a life insurance first and foremost. And life insurance in and of itself, and I'll speak to that in a minute. Life insurance in and of itself is a tremendous, powerful financial vehicle in and of itself. However, it can also be used as a personal banking system, or you can, or in realistic terms, or what it is you're basically accessing the cash value when you see it appropriate. So let's talk about life insurance. Let's talk about the concept of it and how that's structured. So you've got premiums coming in. Premiums are what you put in. That's the money that you put into the policy. So you put premiums into a policy. The policy has some accumulation of equity. When you put money in a bank, it's called a savings. When you put money in a life insurance policy and you have equity, it's called cash value. So you build cash value inside the life insurance policy. And this personal banking system, or the concept of having a personal or family banking system, says when I want access to cash, I use my life insurance policy, and here's what it looks like. You actually go to the insurance company, say, hey, insurance company, I want X amount of dollars. Let's just, I got a piece of real estate here. So let's say we're investing in a piece of real estate. You need $50,000. So you say, insurance company, send me $50,000. They're going to then look in your policy and see that you've at least got $50,000 of equity or cash value to borrow against. Okay. And they're going to leverage or collateralize whatever amount of money that you've requested, as long as you got that cash value in your policy. So the restriction there, or the limitation, is how much cash or how much cash value you got in your policy that you can leverage, or the insurance company will leverage and lend you money. So you are borrowing the insurance company's money. You are not borrowing your policy's money. So that's an important factor. Again, there's a lot of misleading information about this, and these personal or family banking concept. Excuse me. Let me back up. Using a whole life insurance policy as a personal or family banking system, there's a lot of misinformation out there about these. There's a lot of fluff, a lot of spins, a lot of trying to make it something that it's not. It's really, here again, there's no magic to it. It's very simple, very straightforward, and a very powerful tool. And it's called all kinds of things. I've heard it called infinite banking. I've heard it called velocity banking, although that's something completely different that I just described. I've heard it called family bank, personal bank, bank on yourself. I've heard it. I mean, there's you know, a whole bag full of variations of names for this concept. And again, it's the concept of using a whole life insurance policy or a life insurance policy as a personal banking system. I do specifically recommend only using whole life for it. There are a lot of people out there that will say universal life is better. That's a different conversation, and I will get into that at a later date. My recommendation is whole life. I understand these policies, I've seen them, and there are additional pitfalls or dangers with universal life policies that whole life policies don't have. Again, I'll get into that in a different conversation. So back to this, you borrow from the insurance company, and in this case, we're buying a home. Now, they're going to ask you two really tough questions when you go to borrow this $50,000. The first question is this you? They want to make sure that it's you borrowing, you're borrowing against your policy and not somebody else. So they're going to confirm that it's you asking for that money. And the second question is, where do you want the money sent? That's it. Okay. They didn't ask what you're buying. They don't, it's what's considered an unstructured loan. It is a loan, and because it's a loan, there is an interest cost. So let's throw an interest cost over here. Let's say 6% over here. But it's unstructured, meaning there's no repayment schedule. Okay. No repayment schedule. There's also it's not reported. Not reported to the credit bureaus. Again, it's an unstructured loan. You can pay it back, or you can choose not to pay it back. Okay. Of course, if you choose not to pay it back, then the insurance company is going to use your cash or cash value technically to satisfy that loan that you've taken from them. There are no credit checks. No credit checks. You cannot default on this loan because it's collateralized dollar for dollar with your cash value, aka cash. So You can't default on it. And if you happen to die while there's an outstanding loan, the death benefit is still paid out to your beneficiary less the outstanding loan. So if you live and say, I don't want the loan, I don't want to pay it back, and I don't want the loan, the insurance company will simply say, okay, well, you've got X amount of cash value. You've got a loan here. We're going to pay back that loan, and the remainder goes to you. So that's if you choose to cancel the policy with an outstanding loan. And if you die with an outstanding loan, the insurance company says to your beneficiary, here's your death benefit less the outstanding loan. So either way, it's paid back. That's why there's no credit checks. You can't default on it. Now, when you pay this loan back, you do not pay your policy back. Again, you did not take your money out of the policy. When you pay this loan back, you pay the insurance company back. You borrowed their money. This is an important thing to realize for two reasons. First of all of your cash value still has guaranteed growth. Guaranteed growth. And if it's with a mutual insurance company, it also receives or can receive dividends. Dividends. So if you had borrowed your money out, it wouldn't be there to have growth and dividends. You didn't borrow your money out. Now, the other thing is, as long as these policies stay within the IRS guidelines that they give us, then you have access to your cash value, including the growth, income tax free. When I say access, I mean access to borrow against. Here again, if you have gains on your money and you have not been taxed on that money and you take it, the IRS, of course, wants a piece of it. So this is untaxed, unrealized because you're not taking access, or excuse me, because you're not taking possession of it. You're saying, hey, I am putting up my asset as collateral for a loan from the insurance company. And the IRS does not consider a loan a taxable event. Just like it wouldn't consider, if you took your home, even though you may have purchased it for $100,000 and it's worth $300,000, if you go to the bank and say, "Hey, I want a $300,000 loan against the value of my property," they're not going to say, "Well, how much did you buy it for?" And we got to account for the difference and send the IRS a check. They don't say that. They say, "Yeah, we're happy to lend you $300,000 on your asset." They don't care what you bought it for, but your asset is worth $300,000, and you don't have to pay in this case if your basis on a piece of real estate is 100,000, but your value is $300,000, you can go and borrow $300,000 against it, and the IRS does not need a check for that because it's not realized gains. You have not taken possession of those gains. Same thing with life insurance. All right, so premiums. Your premiums go into the policy. It builds cash value. You can borrow against it from the insurance company, and you can take that money and do whatever you want with it. Hey, I've got a piece of real estate here. I happen to like investing in real estate. There is an interest cost because you're borrowing the insurance company's money. When you repay the insurance company. You do not pay your policy because it didn't come out of your policy. Now, there's a lot of noise out there that says, you pay yourself, if your borrowing rate is at 6%, you're paying yourself back at 8% or 10%, then you're building that money quickly. Okay. You cannot pay the insurance company back at 10% if their lending rate is 6%. However, this concept, the difference there, that additional 4%, so this 4%, and you would have to keep a separate accounting of this because the insurance company does not keep this accounting. Again, they don't care because they only want their 6%. So this additional 4% would go back into your cash value directly, and it can only go in one way, and that's by way of a paid up addition. Paid up addition. Because Extra money can only go into your policy one way, and that's by way of paid up addition if you've got that option available on your policy. So you can't borrow yourself wealthy from a life insurance policy in just borrowing and paying yourself back. Here again, there's misinformation out there that implies that. That is not true. There's no magic to it. It's just math. The additional 4% would go in as a paid up addition. You would have to keep a separate accounting of that because the insurance company does not keep that accounting. Hopefully that clears up some mystification and misinformation on this. Now, why life insurance? Well, life insurance, and I'm talking specifically about whole life insurance. Like I said, I'll get into the variations of life insurance in a different video because there's a number of variations, some of them great, some of them not so great. For this conversation, again, I recommend whole life insurance, specifically properly structured whole life, and I'll do a separate video that talks about how to structure these policies. But it's a whole life insurance policy. Make no mistake, it is not a banking policy. If you go to the insurance company and you say, hey, I want to talk to somebody about my banking policy, they say, you have a life insurance policy here. If you want to talk to somebody about banking, you need to go talk to your bank. We do not bank, we are life insurance. So you got to be clear about that. It is a whole life insurance policy. You are using it to access cash value. Some benefits of whole life insurance. This is not an exhaustive list. There is a death benefit. With a whole life insurance policy, the death benefit is guaranteed, contractually guaranteed, as long as your payment is being made. That is not the case with all the variations of life insurance. You've got term, you've got universal life, you've got indexed universal life, you've got variable universal life, and then a number of other ones. Uh, However, with a whole life policy, that death benefit is guaranteed as long as you make the premium payment. With all whole life insurance policies, you will build cash value. That cash value is what you can access at any time for any reason. That's what we're talking about, that people do happen to use as a personal or family banking system. That is not, it's not the main purpose of the policy, although a lot of people do structure them that way. Understand that the foundation, the product, what you're purchasing is a whole life insurance policy, and it has cash value, and you can use that cash value at your whim. With whole life insurance policy, they have guaranteed growth. And you have two components of growth. You have a component of guaranteed growth. There's a contractual component in all whole life insurance policies that guarantees a specified growth rate on all of the policies. You also, as long as your whole life policy is with a mutual insurance company, you have the possibility, and I dare say probability, of a dividend. The reason I say probability is because a lot of these companies have been in business for over a century and paid dividends consecutively every single year. So a high likelihood or a probability, and certainly a possibility. They are not guaranteed. Dividends are never guaranteed. You have access. You have access to your cash value at any time for any reason. Again, we talked about some of this. I said there are no credit checks. It's not reported on your debt to income or to the credit bureaus. Therefore, if you do go to a bank and try to acquire a loan, it does not come up. That's powerful. And it's an unstructured loan, meaning there's no repayment schedule. So access. By having access and having cash value, you have control. You have more control over a lot of other places that you could put that money. It's a great place for liquidity. It can strengthen retirement. I'm not going to get into all the details here. I will just say that having a whole life insurance policy in your financial picture enhances any and every other retirement plan you have or could have, including including typical retirement plans like 401ks and IRAs, pensions. All of those things are enhanced by having life insurance. And again, I'll get into that. I'll get into whys and hows in a different conversation. And also, because of that death benefit, come full circle here, you're able to leave a legacy. You're able to guarantee a legacy as long as those payments are made. Now, payments being made does not necessarily mean, if you get to be 80 years old and you're like, hey, I can't afford the payment anymore, or I don't want to make the payment anymore, it doesn't mean you're going to lose the policy at that point in time. There's lots of different options. You've got, and I'm not going to get into details of what they are or of the options, but there are a few options. I'll name them. So first of all, you got a reduced paid up, where you reduce the death benefit, but that's a fully paid up policy. Again, you have it, it's in place, and it's guaranteed. Even if you reduce pay it up, it's still guaranteed and it will still pay out when you pass away. There's something that's called premium offset, where your premium is being offset by the growth in the dividends. You can literally offset the premium of a policy, specifically a whole life policy, with that premium offset option. What else? Depends on how it's structured. You could reduce how much you're putting into it and then just keep putting into it. But primarily the reduced paid up and the premium offset are options where you can stop paying and the policy will continue to perpetuate itself the rest of your life. Now, with the premium offset, the premium is actually still being paid. So what I said is that death benefit is contractually guaranteed as long as payments are made. Well, with a premium offset, the payments are still being made. They're just being made from the growth of the policy rather than out of your own pocket, but they're still being made. Now, a reduced paid up, that premium is fully paid up at that point in time. So you have a guaranteed legacy there, or the option for a guaranteed legacy. And that again, there are different levers that you can pull depending on your circumstances, but whole life is a very, very powerful tool. Of course, I do sell it. I'm a insurance broker. I sell life insurance, sell multiple lines of life insurance and multiple types of life insurance. And I'm happy to assist you with yours. I've done another video where we talk about the recommended amount to put in these whole life insurance policies. So look for that. And there will be some links in the description below where you can click on, and there's a Paradigm Life link where you can click on, get more information about life insurance. And then if you'd like to schedule something with me, I'm certainly happy to meet with you. Anyway, I hope this is beneficial. Hope this is informative. And if you like this information, if you like this content, please like and subscribe, of course, and then leave me comments on information or things that you would like to see, concepts that you'd like to see expanded on. I'm happy to do so. Until next time, sure appreciate you all. Have a good day.